Hey, welcome back. To continue the oil video, we are now looking into Petrobras, SHEL and Ecopetrol. I recommend first watching part 1 posted a few days ago to get a wider perspective, not to mention that all three companies that we talked about are actually very interesting. Now, Petrobras, this is a state-owned Brazilian oil company that's actually the largest company in Brazil. They have very low-cost operations and are, in my opinion, one of the best oil companies on the planet given the risk-reward and valuation. They plan to ramp up the investments and exploration as part of a new 5-year plan, which I'll mention in a bit and I already looked into in more detail in the valuation. Now, it may seem unreal how much money this company can make. On a 70-80 billion market cap, they can make almost the same as Exxon, which is exceptional on an 80 to 100 billion revenue. Comparing them to Exxon, a nearly $500 billion market cap company, so like 6-7 times more expensive, that's about a third of the revenue, but their cash flow is only a bit higher. That's because this company has amazing margins thanks to very cheap production, which also allows much more investing and dividends, but more about that in a bit. Financially, we see an okay position, with the current assets below the current liabilities, but a ton of assets to more than offset everything. The debt is spread well into the future, and with short-term credit plus the cash flows, they shouldn't have an issue. What's very attractive is that at the moment of recording this, the equity isn't very far from the market cap. And keep in mind that this equity is converted into USD, so it fluctuates based on the Brazilian currency, but in reality, it doesn't move like that. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. An issue with Brazil in particular are the massive rates which have an effect on the economy. They've always been very high to attract investment. That also makes debt more expensive, but in the very long term as the country develops, it has potential to go down and stimulate the economy. We've seen the country cut it even in half from the current level like a decade ago, not counting 2020, which can have a very good effect on the stocks. And as a parenthesis, a weaker local currency is actually good for a company that's exporting in USD. Every dollar that you bring into the country now can be worth, let's say, 10% more locally than it was a month ago. It's an extreme example that would probably require rate cuts, but you get the idea. They plan significant capex to continue developing a lot of projects and more exploration, but that depends on the price of oil. They have a very low break-even of 28 per barrel, and above 45 they even make enough to not cut the capex. This is one of the best positions on the planet at such a size. Sure, Saudi Arabia and a few others are even better, but that's more complicated and risky. The minimum mandatory dividend in Brazil is 25% of the profit, and they usually pay something around that. So they should probably be able to pay something unless we get into a very bad environment. But from the current price, we are looking at potentially 10-15% or even higher dividends in the long term. But keep in mind that if they have a good enough reason, they can legally not pay it, not to mention that it requires a profit, although it's very tough to see them lose money. Still, at the right price, this can pay phenomenal yields on cost plus the upside potential, as we've seen before. And you know, when the treasuries pay 15%, you need a good reason to go for the stock. Now, about that, obviously, such a good company has to be cheap for a reason, although I think it's a bit exaggerated. Brazil is the top shareholder, and we've seen the country limit exports and prices, force investment directions, and basically use it as a political tool. But that also makes it even more remarkable how they can make so much money and have such a good margin. And especially as a state-owned company, the dividends are very important for the country. But of course, that also means potential corruption and things that may not be in your best interest as a shareholder. And keep in mind that oil in general is usually a very corrupt industry to be in, especially if you consider lobbying and basically buying politicians to be unethical. So Petrobras is, in my opinion, one of the best oil companies on the planet. The fact that they have such a low break-even and a very low valuation, which leads to a massive dividend which is mandatory in Brazil, is really tough to beat. Even if there isn't growth, and in general general, there isn't really that much growth in commodity stocks, they depend on the cycle, the dividends alone can make it into a very good investment. If I manage to buy this during a time when the market is afraid, which is ideal for me, this has potential to be maybe one of my best long-term investments. Potentially getting 20-30% average dividends in the long term would be really a once-in-a-decade opportunity, so I'm definitely keeping an eye on them. But of course, there is political risk, but let's not pretend there's not a thing in other countries, including the US as well, because that's why we are here now. And if that potential isn't enough to justify taking the risk, I don't know if anything is. Now, Ecopetrol, this is a Colombian state-owned company with a lot of production and infrastructure assets in South and also North America. A majority of the reserves are in Colombia, but they also have some in very good areas like the Permian in the US. However, we see another significant focus on natural gas, carbon capture, hydrogen and so on. By 2040, they target about 40% of the capital going into low emissions, which is definitely a lot. They can make from nothing during the down cycle to even 5-6 billion recently, even we double the capex, so definitely a very low ratio on a not even 20 billion market cap. However, Colombia enforces a 50% minimum dividend payout, and this is why the company was recently at like a 50% dividend yield. And at the same time, this is a state-owned company, so the country literally depends on that money, so it's very likely to see them keep paying a dividend almost no matter what, as they usually do. They'll cut it as oil prices fall, but even a 10-15% on average can be very attractive, especially since they also have the potential of the stock trading near all-time lows on top. Financially, we see an okay position with the current assets covering the current liabilities and a lot of assets to offset the debt. The maturities of the notes are also relatively low yield and far into the future, so it's actually not bad. The equity is at around $26 billion, so actually well above the market cap, so we currently get this at a discount to net asset value. But again, keep in mind the political risk. As Colombia's state-owned oil company, there is significant political influence and even allegations of replacing some of the staff with political supporters, so the classic. However, the president of Colombia even played a major role in cancelling a very significant project with Occidental in the Permian, so probably a very profitable project gone because of politics, plus potentially something around $5 billion in a tax dispute that's currently still pending, so low ratios actually make sense. So it's healthy and it made a ton of money, but who knows what some politician may want to do with it along the way, so this is why they'll always trade at a low ratio. Now, to be fair, political instability and extreme changes from left to right should be very common in the near future for Europe and the US, so are their ratios justified? Sure, safer overall, but can also be very directionless if they can't agree on the future and we see long-term plans changing after 3, 4, 5 years. Not to forget that oil is among the most politicized subjects, so it's definitely affected. The margins are also quite high, significantly above Exxon or Chevron, kind of similar to Occidental. But some worries I see on Seeking Alpha, check the link below for a discount by the way, could be said for pretty much all oil companies. You have a very solid and profitable business with infrastructure and everything that is, in this case, literally forced to go into an unknown territory. You know, as I said in the previous part, Exxon for example is taking a very careful approach and probably waiting for others to figure out what works and then just buy them. What if after you spend 10 billion on something you realize the infrastructure doesn't hold and you aren't allowed to invest in it or need to spend another 5-10 billion or there isn't enough demand? However, what's the future of oil companies? Sure, you get another 2, 3, 4 cycles out of it, but it literally takes one politician to see a very significant shift towards greener alternatives. Not all companies have Exxon's valuation and money to wait on this, so they have to take the risk. And especially in this case, when you are Ecopetrol and the country wants to depetrolize the economy, you are caught in a very tough position. But on the other hand, politicians change, so that could also be a potential catalyst. So if you want a much higher risk and potential reward, Ecopetrol is definitely one to look into. Very solid and healthy company trading below a net asset value that's able to make a lot of money. But is it worth anything when politics are kind of against you? Again, they were forced to divest out of the Permian with Occidental, a likely very profitable project gone literally because the president said so. Now Shell, this is the largest European oil and gas company, and it's actually very similar to Exxon. They are a global fully integrated producer and also focus on hydrogen, LNG, renewables, mobility and so on. On a production level, it's about half of the oil equivalent per day that Exxon is producing, but the numbers they manage to deliver are very impressive. They can make a ton of money, around 25-30 billion on average, which is very similar to Exxon, but the market cap is significantly smaller. And on a cash flow level, Shell is actually much more efficient when it comes to the margin. Based on last year's cash flow, the ratio is something around 5.5 to 6, so well below Exxon. Sure, it's not accidental or Petrobras level of margins or even ratio compared to Petrobras, but such a low ratio for one of the biggest companies in Europe and a key player in oil is definitely not bad. Financially, we see a good position with the current assets covering the current liabilities and a ton of assets to offset the debt. The equity isn't very far from the market cap, so that's definitely a plus compared to Exxon or Chevron. But with all the commodity companies that I mentioned, keep in mind that after an upcycle, the equity is inflated. What I mean by that is that the inventories, hedging, derivatives and stuff can instantly fall in value, while the property and equipment can also do that if the environment is bad. You know, say oil drops and stays at 50 for half a decade and you have a 1 billion project that only makes money above 65. In that market, it's not worth a billion if you want to sell it, because you can know if you want say 65 as the upcycle and then back to 45 or whatever. Keep this in mind even if they don't change it on the balance sheet now. The impairments can take several quarters to hit. Now the, issue is that the stock barely moved despite all the recent developments and crash in oil. And that's despite very recently facing about a 20% opposition from shareholders regarding prioritizing LNG, which I actually like. And about that, something I really don't agree with the CEO on is that he basically said that buybacks at the current level are an excellent way for them to spend money instead of acquisitions. So instead of using the cash or even the stock to buy others, and there were some rumors about them looking into BP, they prefer keeping the stock inflated. Instead of letting it fall naturally and then doing the buybacks, they literally waste your money now. But that's unless they aren't preparing some kind of acquisition using the stock, in which case it makes sense to inflate it. You know, we don't have the behind the scenes info that the CEO has, maybe they are already talking with someone. However, the overall direction and massive focus on natural gas, LNG and hydrogen is something that I really like, and I agree with the CEO. I mentioned this with Total in the previous part, but LNG, natural gas and especially hydrogen are very likely here to stay for much more than oil. Even after the transition to green, this can still have a role in the energy mix. Sure, it's not the greenest and there is room to improve, but we are working on that. The dividend and buyback policy is around 40-50% of what they make throughout the cycle, so in theory that's around a 5-6% total yield from the current level. But currently they do massive buybacks of more than 3 billion per quarter, which alone is more than a 6-7% yield. That definitely had an effect on the price, but keep in mind what average means. In bad times, when the stock is cheap, they probably do little to no buybacks and only pay the dividend, which is very sustainable to be fair. So bad times will be even worse because there is a sudden drop in demand from the buybacks. But getting it when the market hates it and it drops can be very rewarding and boosted by them in good times, which I think is optimal for a commodity stock. They say that the buybacks should be sustainable at around 50 per barrel and the dividend should have a break even at around 40. So at or below 50 we can see some issues but still an okay dividend, and below 40 is when we see the real trouble and self-preservation mode. Also, cutting the buybacks at around 50 means that might be when we could expect a crash because a big source of demand is gone. So I like Shell and I think it's among the best very big companies. Healthy, nice financials, makes a ton of money, relatively cheaper than Exxon, pays a better dividend, but the stock is not very far from an all-time high despite the environment getting much worse and the price of oil dropping so much. So when the issues begin to show, we might see the market adapt, especially since the buybacks would be cut, which is why I think this can drop quite a bit. But even if they made like 20 billion now, this would still be much cheaper than Exxon. It's basically like paying half the price for a very similar company. You can see on the screen a summary for each of them. I don't think they are that strong of a buy right now, but it's definitely an industry to keep an eye on. My picks for the overall investment quality in order would be Petrobras, Accidental, and then Total and SHEL and the rest. Chevron I don't even want to mention until they change the management that's behind the Hess deal. Looking at it, it's literally like they felt pressure to copy Exxon, and honestly, with so many other better options, why go for them other than the popularity in the market? Exxon, on the other hand, is a good and vital company for the US, but it's very likely to not see this at an attractive valuation because it's the market favorite and an S&P component, so it will always be inflated. Petrobras probably remains my top pick in the industry, but I'd like to diversify and not rely only on Brazil. So something like Accidental for US exposure and Total or SHEL for Europe would be the mix that I'd go for. And Devon for a smaller value play could also be pretty attractive. Of course, it's a matter of price, and I'd prefer getting them at least below equity to have a better margin of safety. Maybe even something like 25% below it or even more. And another important topic, or actually two, I think would be natural gas, which I talked about before, and energy companies. Especially the latter is literally vital, and I think it can be a nice thing to have exposure to. Let me know if you want me to make a video about them as well. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.